Okay, let's just dive right in. The last few weeks in the crypto markets have been, well, a total bloodbath. What looked like a small dip just kept going, turning into a complete free fall. And it's left a lot of people wondering what on earth just happened. Today, we're going to break it all down, dig into the data, and find out what was really going on behind the scenes. Let's do it. First up, let's just try to wrap our heads around the sheer scale of this thing. In just over a month, more than $1 trillion in value just vanished from the total crypto market. That's an absolutely insane number, no matter how you slice it. And you know what's really brutal? The speed. Remember all that momentum we saw building up for most of the year? Poof, gone. Bitcoin dropped 27% in just 6 weeks, completely wiping out all the gains from this year. It's like the market just hit a giant reset button. Now, every headline has a simple story, but a crash this bad, this fast, it makes you ask the question, right? Was this just crypto being crypto, doing its volatile thing? Or was something else, something hidden, pulling the strings and making everything so much worse? That's exactly what we're here to figure out. And you can feel it, right? The mood out there is just awful. The crypto fear and greed index, which is basically a mood ring for the market, has absolutely cratered into extreme fear. We haven't seen numbers this low since way back in February. This isn't just people being a little nervous. This is the kind of fear that signals mass capitulation, where people just give up and sell at a loss to get out. All right, so to really get to the bottom of this, let's start with the obvious stuff. The usual suspects, the reasons you've probably already heard that got this whole ball rolling. So the first domino to fall? That was the US Federal Reserve. The market was really hoping for a clear sign that more rate cuts were coming. And while the Fed did cut rates, the chairman's comments afterward basically poured a bucket of cold water on any hopes for more cuts anytime soon. And you can see the cause and effect play out perfectly right here. Last week, the Fed makes its move, but sounds cautious. Right after that statement, the chances of another cut in December just plummeted, from a near certain 90% all the way down to 63%. And by this week, that new reality sent investors running from riskier assets, and crypto was right at the front of the line. And yeah, the numbers absolutely back this up. Since the start of November, institutions have yanked over $3.6 billion from Bitcoin exchanges. When the big money starts running for the door like that, it sends a major chill through the entire market. So there you have it. That's the story on the surface, right? The Fed got nervous, the big institutions pulled out, even long-term holders started selling. October, which has been a winning month for 7 years straight, was a total bust. It all seems to make sense, but here's the thing. That's not the whole story, not even close. Because what very few people were talking about was this huge, hidden problem just bubbling under the surface, one that was about to take a regular market dip and pour gasoline all over it. And that problem has a name. It's a liquidity collapse. Now, what the heck is that? Well, think about it like this. Imagine you're trying to sell your house, but overnight, every single potential buyer in your town disappears. What do you have to do? You have to slash your price, right? That's what happened here. The market's depth, its pool of buyers, shrank by 33% since October. There was nobody there to buy what was being sold, which made the market incredibly fragile. And this is so important because suddenly the math just wasn't making sense. We could see about $2.3 billion in selling from those big ETFs in November. But the way the price was crashing, it felt way, way bigger than that. So where did another $6 billion in selling pressure magically appear from? Well, the answer, it turns out, lies with this new kind of company on the scene. They're called digital asset treasury companies, or DATCOs for short. These are public companies that went out and raised billions of dollars, a lot of it through debt, just to pile Bitcoin onto their balance sheets. And hey, it was a brilliant strategy, as long as the market was going up. But as soon as the market turned, that debt-fueled plan created a truly vicious cycle. You can see it here. Step 1, they borrow billions to buy crypto. Step 2, the market crashes, which puts their finances under massive stress. Then comes step 3, they breach the terms of their loans, which forces them to start selling their crypto to pay back the debt. This wasn't a choice, it was mandatory. And that leads to the final step. Their forced selling tanks the price even more, which forces other companies to start selling. It was a true death spiral. And look, this chart right here says it all. On the left, you've got the selling pressure we all knew about from the ETFs. But over on the right, that's the potential forced selling from these datcos, a mind-blowing $6.4 billion. It absolutely dwarfs the other number. This was the secret tidal wave that crashed the market. Okay, so we've uncovered the hidden villain here. Now the question is, with all this selling pressure in the system, where does the market finally make it stand? Where's the final line of defense? And if you look at the charts, things are looking, well, pretty grim. We just got confirmation of what's known as a death cross. For anyone who doesn't follow technicals, it's a classic bearish sign where the short-term price average dips below the long-term one. It's a signal that this isn't just a quick dip. It could be the start of a much deeper, nastier trend. Which, of course, brings us to the million-dollar or maybe trillion-dollar question on every single investor's mind. Where does the selling stop? Where is the floor? Well, according to analysts, every single eye in the market is now fixed on one single number, $88,000. This isn't just some random support level. People see this as the market's ultimate line in the sand. So why that number? Why is everyone so obsessed with it? Because 88K is what's known as Bitcoin's realized price. Put simply, it's the average price that every single person who currently owns Bitcoin paid for it. If the market price falls and stays below that level, it means the average holder is now officially underwater, at a loss. And historically, that is the exact psychological trigger that unleashes the final brutal wave of panic selling. Okay, let's step back for a second. We've got the trigger, we've got the hidden accelerant, and we've got the final line of defense. But what does all of this really mean for the bigger picture? The biggest takeaway here is that this is way more than just a price correction. Some are calling it a solvency cleansing. It's the market violently and painfully purging itself of all the crazy leverage and risky, debt-fueled schemes that were built up during the good times. It's a reset, painful as it is. So what we have right now are these two completely different truths happening at the same time. On one hand, the short-term risk is off the charts. We've got this cascade of forced selling hitting a super fragile market. But on the other hand, you could argue the long-term foundation is actually getting stronger, with things like the Genius Act bringing in regulatory clarity that big institutions need to see. And that leaves us right here with the big, final question. Are we just watching the ugly end of another speculative crypto bubble? Or is this something different? Is this the painful, messy, violent process of creating a healthier, more mature, and ultimately stronger market for the long run? Well, I guess we're all about to find out.